to another episode of Gossip Finance, where I'm your host, Jill Schlesinger.
And I'm Duncan Sandlin. How's everybody doing? How's it doing, Lace? How are you?
I'm excellent. I can't wait to jump into the news.
You can't wait to jump into the news. You're all excited about the Fed, huh?
I'm super excited about the Fed. I mean, I could be more excited about the Fed, but I could definitely be less excited about the Fed.
I don't know. Jerome Powell, white hot sex pot, that guy. I'm telling you.
Yeah, I know he's your type.
Oh, yeah. I like him old and pale.
We are ready now to go for the Fed decision, and Steve Leisman.
The Federal Reserve maintaining its interest rate at 5.25% to 5.5%, but the committee continues trying to determine the quote extent of additional policy firming that may be appropriate. So there's this bias in the statement suggesting they're still looking to raise rates, and indeed the average Fed forecast does continue to look for one more hike this year with an average forecast of 5.6%. Importantly, and I'll come back to that, there are two fewer cuts, 25 basis point cuts built in for next year. On the economy, economic growth was upgraded to solid from moderate. Job growth was said to have slowed, but remained strong. Inflation remains elevated, and the committee repeated its commitment to a 2% inflation target.
All right, so let's boil all that down. So one thing about finance is there's all this jargon, and they love to throw numbers at you, and part of it's because we want you to think we're smarter than you are. But really,
and they want to make it sound like they're saying something that's like way higher level and way classier than what it actually is.
Right. So essentially, this is it.
So dumb it down for us, my friend. Dumb it down for us.
So the Federal Reserve Bank they set the rates on borrowing money. Essentially, they're basically the government's bank, right? So they could have all the government's money and they issue out most of it. The Treasury does too, but that's a different branch. But they issue out a lot of money and they issue out bonds and things like that. So they set whatever the rate is going to be, and then that goes to the banks who borrow that, and the banks that borrow from them, and down the system, right, all the way to us. Now, the reason you raise rates is because you want to cool off the economy. You want to slow down the economy because you're afraid it's getting too hot. There's going to be too much inflation, which can be really bad. Well, that was part of their big concern, is they were afraid coming out of COVID, inflation was real high. It was too hot. Now, we know inflation was high not because of traditional causes, right? Like part of it was some supply-demand shit or lack of supply. But a lot of it was corporations realized people are coming out, they're spending. We can now inflate the prices as much as we want for the most part, and people will still pay it. So it was artificial inflation so they could maximize their profits. They basically, let's screw the consumer was the game, and they got away with it. I mean, they were going to get away with it. So that's what caused a lot of the inflation. The inflation's been coming down, though, since people have been back to work, and it's been more level, right? Now there's more competitors back in the market. So I'm not sure that the Fed did anything really to cool inflation by raising rates. Now, inflation was high. It peaked at 11. It's down to whatever it is, 3.68 now, which is up from last month. It was like 3.17. So it is a big jump. But nonetheless, 3.68 is not terrible. The average historical rate in the U.S. is like 3.2. The Fed wants to get it down to 2. I'm not sure. That's kind of their magical number for some reason. I'm not sure where they get that from.
So that number, as far as you're concerned, is a bit arbitrary.
Yeah, I mean, you want inflation to be around 2.5% to maybe 3.5% at any given time, right? So when they say they go 2, it's like, well, what you've done is you've set a bar that allows you to kind of willy-nilly decide what you're going to do with the rates, right? It's I can't think of a good example, but it's basically, it gives you an excuse to do what you want, right? It's a get out of jail free card. Well, the rates aren't at 2, inflation's not at 2, so we're going to raise the rates again until it goes down. Well, it's like, is it really affecting inflation though at this point? Can we say that? Do we know? You could make an argument one way or the other because the inflation was coming down before they did this. So what they've decided is we're going to keep them up to where they're at. Right now, they're between 5.25% and 5.5%. Okay. What does this mean for you, the average person? It means if you go out and buy a car, you're going to be paying higher interest rates on the loan. If you buy a house, higher interest rates on the loan. Housing interest rates were at an all-time low back in 2019. It was like 2.7%. So you bought a new house, you pay 2.7% interest on that loan, on the home loan. Now they're over 7%. And they're predicting they're going to go as high as 8%. So people today, you're paying at least 3 times more, or around 3 times more than people were 3 years ago, 4 years ago. So that's what the rate's done. What it's done, though, is it's squeezed workers. And I think the thought of the Fed is traditionally, a lot of the times when you see big inflation, historically speaking, it's because pay has gone up, or workers' benefits have gone up, and companies have been sort of strangled to have to pay these higher wages and to be competitive to get workers. And that's caused a lot of inflation historically, but we know today that's not what caused the inflation problem. And it's a different market today because just Lacey and I's generations, not considering even the new kids, right? The alphas and the Z's coming out, right? Our generation was 3 times more productive than our parents. One of us was worth 3 of our parents, right? So productivity has made up a lot of the difference in growth and money. And part of it is because how we're educated. Part of it's machines. I will say this, a lot of millennials and younger people are lacking in basic English skills. Lacey can tell you all about that.
Yeah, that might be another video, Doug. That might be another video.
But they are, but they're real.
Save that for the one where people want to watch something like old Yeller and cry.
Yeah, we can bitch about that some other time. But
right.
But they are better with computers and they are productive. Right. And with a computer, like just financial planning, right? It used to be to run a practice, I'd have to have 3 or 4 people working for me. Now I can do all that with a laptop and the right software. You know, saves me tens of thousands of dollars. So that's what's going on. Is they're saying, okay, we're going to keep the rates high. Part of it is to strangle workers. I think that's just my opinion. I could be wrong, but I think it's they're upset because workers are now sitting there going, "Oh, wait a minute, these companies made all these profits. We didn't get a raise, and the wealth and income gap has grown. It's still growing, and it's peaked in this country." And it's worse than it is in any other developed country for the most part. So that's what's going on. That's it. I mean, that's the whole kit and caboodle right there. I mean, there's not much point in watching any more of this. That's all that's really happening. We're going to keep rates high. Why? Because we want to sort of squeeze the market, and we're going to do it by basically making it impossible for middle and lower income people to buy homes and cars and shit and to borrow money.
And let's not forget that those, middle and lower income folks that have student loans have those payments coming due too. So that's even less that they can afford. I know it's related to a different thing, but it's all a part of your wallet and it all impacts what you can actually afford. So it just got a whole lot tougher for a whole lot of people.
Well, and the other counter argument to that is it hasn't all these rate hikes they've done for the last couple of years hasn't slowed down the economy at all. So it's not really having the effect they thought it was going to have.
Well, yet they're going to jump around and shout victory for sure.
Yeah, at some point, yeah. It was part of my master plan all along.
Right, exactly. This was definitely a part of my plan. This was my mastermind. No, it wasn't really.
No, you're an idiot. All right, so let's, we'll do a little bit more with this with the rate hikes. We'll do Money Watch on CBS Mornings. Are you ready? So she's this analyst. She's going to talk a little bit about the rate hikes, but then she's going to go into the auto union or the United Auto Workers strike, the union strike. And we're going to have a discussion about that because that's really fascinating. So I think this woman, I didn't see this whole clip, but I think she soft soaks this quite a bit.
In today's Money Watch, we are talking about the government's latest move on the economy. The
The Federal Reserve decided to hold interest rates steady yesterday after raising rates 11 times in the past year and a half to fight inflation. Meanwhile, the United Auto Workers strike against the big three automakers is in its sixth day, with about 13,000 workers on the picket line. Yesterday, General Motors and Stellantis announced new layoffs that they blame on the strike. CBS News business analyst Jill Schlesinger is here to break it all down like boxes on recycling day. How are you doing?
I'm doing well.
All right, let's jump right into it. So the Federal Reserve, why did they decide to keep interest rates the same and steady?
They basically believe the economy is expanding at a pretty solid pace, that the employment landscape is good, and they are encouraged by the most general categories of inflation coming down. So as a result, they kind of are saying, we need to take a pause right now. We may raise them in the future, but for today, we're good, and that was it. So we are still, though, at a 22-year high in short-term interest rates, 5.25% to 5.5%. Borrowers, you better get used to it. This is going to be sticking around for a while.
So I also want to say this. So you already mentioned that. Now they're going to take a victory lap. She just kind of already did for them.
Yep.
Oh yeah, no. See, inflation's going down. They did it. See, it's the economy's great. It's really stable, and it's all because they were trying to slow the economy. That's what raising the rates is supposed to do. It hasn't slowed the economy. The economy's crushing it. I mean, the economy's doing really well, and it's growing and growing, and inflation's starting to go down, and it's not. You can't sit there and go, well, we're going to raise rates to combat inflation by slowing down the economy, and the economy doesn't slow, but inflation goes down, and go, that was me. No, you were trying to slow the economy. That's all you were trying to do. Right? And you didn't do it.
They're going to spin it just like I called it.
Yep.
They're going to spin it so they can take a victory lap, so that they can tell the American people that all the stuff they did with the rate did exactly what we needed to. So now we're doing awesome.
Right.
And the average person is going to go, okay, I guess it did what they wanted it to do. Not realizing they're making shit up.
Yeah.
They're literally, they're making shit up.
Well, you could make the argument, but the bottom line is she's not even making the argument. She's just saying that's what happened. It's like, is it though? Is it, Jill? Is it really? So let's watch a little bit more of Jill here. Jill's gonna break it all down like recycling boxes on recycling day.
What does it mean for inflation? I know their goal is to get it down to 2%.
Yeah, I mean, they've made great progress if you think about it. In the summer of 22, we reached a peak of the consumer price index, 9.1%. It was horrible, right? We're now down to 3.7% on an annualized basis, but the Fed does target 2%. They think that's the right pace for the economy to grow, to create jobs, and for workers to be okay with their take-home pay. Well, I'll tell you what's going to be hard for the Fed. Going from this current level of 3.7 to 2%. This last 1.7% is going to be difficult for them.
You keep hearing people complain about the cost of things, but then you hear about how inflation is supposedly going down. Is that number, does that include gas prices and like eggs and milk? And
yes. So that top line number, 3.7, is inclusive of everything. The Fed does like to look at the core level. It strips away food and energy because those are such volatile categories. Like gas prices are up really enormously over the last few months because Russia and Saudi Arabia cut production. So when we take that out of it, the general rate of the core inflation is driving lower. And that is good news.
Super interesting. Let's go to the
Yeah, part of that is food, not so much. Food tends to be, groceries and things tend to be fairly inelastic because people need them. You can't not eat. I mean, I guess you could, right, but it wouldn't be a good idea. Right?
I do remember watching a movie like that where we were trying to train the cattle to not eat.
Yeah.
Like giving them less and less every day. I wish I could remember what that movie is, but you know what? It's been tried. I mean, it doesn't work out so well, but...
Yeah, manna from heaven. You can just live on manna from heaven. Anyway, yeah, gas prices, but part of it is she makes, once again, she sort of made this odd point where it's like, yeah, but it's going down. It's like, But how much of that is because of the federal funds rate? Especially when the economy's still hot. Right? How much of that is the Fed rate? I mean, I don't see where she's going with that. I mean, it's almost like she's sort of countering her argument. Not that the average viewer of CBS Morning is going to know that probably. I mean, but nerds like us who follow the Fed, yeah. I mean, it's like, yeah, she kind of disproved the point.